There is a lot of content out there that goes like, okay, you have to buy this now, buy then, buy this amount at this time because the market will do this or is likely to do this. Now the truth is, this is all really bullshit because no one actually knows what's going to happen in the future. That's just all like guesses. Some might be wrong, some will be right. Just by pure chance. So instead of telling you, okay, when you should buy what, which I couldn't give you with good conscience, is introducing here a strategy that works in general and should help you time the market better. So enjoy the video. If we're honest with ourselves, timing is absolutely essential in the investment world. Buying and selling at the right time makes a massive difference. And that's especially true when we talk about the stock market. The stock market is so extremely volatile that buying at the right time, selling at the right time is almost even more important than what you're actually buying. Now the goal of this video is really to give you an easy to use toolkit that can help you time the market better and not fall into the trap of so many and buying and selling at the wrong time, but instead actually using the volatility of the stock market to your own advantage, and that in a quite simple way. First things first, I'm sure most of you have heard of this fallacy that people just tend to buy and sell at the wrong time regarding the stock market, and that's pretty simple, explainable with behavioral finance and psychological patterns, such as if prices go up and up, there's a scarcity effect, and also people get more greedy and believe prices have gone up, they will continue to go up, so they keep buying at these high prices. However, when it crashed and suddenly comes, people panic, they don't want to lose their money, and they start selling. So they buy high and basically sell low. So it's really difficult to time the market right because our own psychology kind of works against it. So that's why I really want to introduce a way where you can trick your psychology or force yourself to actually work against that instinct and actually time the market much better. Now, I didn't develop this strategy myself. I read this from a book written by Tony Robbins, where he interviewed the leading investors in the world, the Warren Buffetts, the Ray Dalios, and so forth. And this has really struck me as a really interesting trick. And I've been using this for some time now, and I hope it can help you as well. So in order for this strategy to work, your portfolio needs to be set up in a certain, however quite simple way. Basically, you need two types of entities. You need one entity, which I call equity. So that could be a share of Apple, Coca-Cola, or an S&P 500 ETF, for example. And another share that is bonds, mainly government bonds and obligations. And the reason is really because those two asset classes move, generally speaking, in different directions, depending on how the market is doing. What I want you to do is looking at these two asset classes and setting a split that you're comfortable with. So let's say you have $1,000. Do you want to put 60%, so $600 into equities, into an Apple, Coca-Cola or whatnot, and $400 in bonds? Or do you want to make it 80-20 or the other way around? This is really based on your risk profile. Usually you can say the higher your bond share is, the less volatility, the less losses you have, but also the less long-term gain. Okay, you have your portfolio set up in a way with a risk profile and a split that you're comfortable with. Okay, how does this strategy actually work? So basically, let's look at scenario one. Let's call it a bull market. The economy is doing really well, everyone's happy, consumers are buying, companies are selling, and stock prices, usually of equities, so of a Coca-Cola, of Apple and others, an S&P 500, they go up in value quite a bit during these times. Whereas US government bonds, for example, or other government bonds, in general, do not go up as much. So what happens to your initial split of your portfolio? You had $600 in equity, $400 in bonds. Well, now you have maybe $800 in equities and $450 in bonds, or just less increase than on the equity side. So basically your split in percentage terms is not 60-40 anymore. It has shifted. So by selling equities and shifting them into bonds, you A, realize the gains that you have achieved over the past, and B, you increase your share of bonds, so you basically ready yourself for a potential downturn, which we all know always comes after an upturn. Now let's look at a more interesting case, and that's scenario two. Let's say there's a crisis. The stock market is crashing, everyone's unhappy, business confidence is really in the cellar, no one's buying, no one's selling. So in that case, like we actually have these days, sadly, your equity share overall will most likely go down. So from your initial 60-40, your share now is only 30% equity and the rest is bonds. Without you having done anything, that's just how the market moves, so your portfolio shifts. Now what I want you to do is sell bonds and buy equities with them, so you rebalance into that 60-40 split. So what does that mean? That basically pushes you and forces you into buying equity when the market is down, when prices are low, a rock bottom. This is exactly what you're supposed to do. Or looking at it in a different way, you're basically buying losing investments and you're selling winning investments. So you're buying low, selling high. Now you might say, okay, that sounds great in theory, but how about practicality? Does it actually improve my returns? Well, yes, it does. There have been several studies made. I just highlight two here that clearly show portfolios with rebalancing versus without rebalancing, and showing that the rebalanced portfolios have significantly returned higher over different time periods. But feel free to have a Google search yourself as well. Now, how often should you actually do this rebalancing? The theories here kind of divert, but I suggest not to do it too frequent, as in like once a week or even once a month, because you also have to account for trading fees that you might have. I believe personally, and that's what I've been doing, a healthy level is maybe every 6 months, every 1 year. Mark it in the calendar, and when the day comes up, look at it, sell and buy the right assets, and you're back in your original allocation. So this channel really revolves around personal finance. I myself been investing in the stock market for over 12 years, but also around financial freedom, which is something that I have been working on lately. So I plan to upload more videos. Please, if you like the content, subscribe, like or comment, and let me know what you guys want to hear. I'm really happy to help.